investment or financial planning and things of that nature. So this is a way for us to connect with each other, all of us, and be able to have a better understanding of what it takes to invest, not only in real estate, but outside of real estate. I always tell people diversify your portfolio. It's very important. Ajay brings his expertise in investing in the stock market and the Wall Street area that I'm not familiar with at all. So I rely on his expertise to give insight. And so I wanted all of us to benefit from his experience in that area. And when it comes to taxes, tax planning, Kevin is an expert, and he's been doing this for many, many years. And I let the experts handle what they can do to help us in our daily world. So with that, I'm going to turn it over to Kevin and Ajay and let them run through their slides and any question and answers. Like I said before, the session is recorded, and the slides, which I will be able to share that on a portal, so that you all can download it and listen to it and look at it later at your convenience as well. And this will also, I have had a few people who reached out to me, asked me if the link was, if the session is recorded, so I will be able to share the link with everyone later on as well. Okay, so Kevin, Ajay.
Yeah. Hey, this is Kevin. I'm going to go through some admin housekeeping stuff, what we're trying to get accomplished, what the format will be, and then I'll let AJ take it from there. Again, this is a very informal Q&A that was put together for the investors for Nirvana Capital Group, and have additional resources to this. Like Rich has mentioned, this session is being recorded and transcribed, and I can send the recording and the transcription along with the slides after, and Richa will send that out. So that's for housekeeping. And since it is an informal session, one thing we do expect is people respect the speaker's time. There is a lot of time built in for question and answers towards the back end. So please hold your questions till we're completed. And we have kind of put this together in a FAQ format. So we will answer very generic questions and kind of lead the discussion over the next 10 to 15 minutes. And then we'll have a lot of time for questions. So, but just, raise your hand and I'll moderate this one by one. And then you can ask questions as towards the end in the Q&A panel, which is going to be 2/3 of the time that we've allotted to this. And so that was kind of for housekeeping. I'll let AJ take it from here. And here we go.
Perfect. Yeah. Thank you, Richa, for putting all this together. Like Kevin said, this is a very informal session. We just want to, be a resource for all of you. Any questions that you guys have, especially with the tax deadline coming up. I'm a financial advisor, like Richa said. I'm also a CFP, certified financial planner, which makes me a fiduciary. I started my career at Aon, which is the investment consulting, one of the top 4 in the world. And some of my clients were Delta, Scana Energy, American Airlines. And what I did over there was, manage their pension plans, their 401k plans, and large pools of money. So I would go out, scour the universe on the best portfolio managers, and build their portfolios the way that they needed for the liabilities that they had from paying out benefits on the pension side, also endowments, foundations, and just cash on hand for large corporations. I wanted to bring that experience that I had over to being an independent financial advisor. So I made that move about 6 years ago now. And I'm an independent financial advisor. I'm not tied to any company. I'm not tied to any product. I'm not tied to, anything out there. Basically, I could shop any product, go to any platform. And what I really want to do is be that unbiased advisor, right? I like to sit down with all of my clients, see what they need and see what they want, and kind of plan around that. So I like to sit down, do that personally. a lot of times people will ask me questions and I can't really answer it just because I don't have the right information, and that's not the right thing for my clients, right? I don't want to just spit out an answer because it may not be the best thing for you. I need more information, kind of drill down, and then I want to plan properly. I've formed a partnership with Kevin over the last 6 years. I've known him probably for 20 years now. And we have a really good relationship where I could be sitting down with a client, they'll have the tax question, and I could just pick up my phone and call Kevin and kind of bounce ideas off of him. Right. A lot of financial advisors don't have that luxury. And also, a lot of CPAs don't have the luxury to having a financial advisor to where they could just call up and ask questions. So we have that good relationship. We're unbiased. I know how he operates, he knows how I operate, and we're a pretty good team in that sense. So yeah, those are my services that I kind of advise on. It's not everything, but it's probably 90% of it. I like to be that full holistic advisor. Obviously, I can't recommend real estate investments, but I could help you kind of look at pitch books and the leadership team and all that because I used to do it for pension plans. It should be a big part of your portfolio. It shouldn't be all of your portfolio, like Richa said. You should be, properly diversified, have some stocks, have some bonds, have some real estate, have some alternative assets in your portfolio. But yeah, with that, I just want to turn it back over to Kevin. That's a little bit about me. And if you guys have any questions on my experience or what I could, bring to the table for you personally, we'll kind of discuss that during the Q&A session.
AJ, why don't you go ahead through the financial benefits of real estate investing, and then I can take on the tax benefits after and do an introduction. So these are some of the big FAQs that we put together and why it makes sense and what it is to invest passively in real estate and why it makes sense and kind of get a financial advisor's point of view on this.
Yeah, absolutely. Real estate, it should be a good portion of your portfolio just because you're getting, consistent income, right? Stocks, they also have dividends, large companies that are paying it out. Real estate, you also get that dividend kind of in passive income. So that's a big benefit there. And then with that, you're also going to get depreciation, which is, a big benefit for a lot of people. You get leverage. Obviously, you're not buying the entire property. You're getting a loan from a bank. So you're able to leverage your money that way. And then the big thing is just diversification. You don't want to put all your eggs in one basket. So that real estate offers that diversification, and inflation is also big. Real estate tends to keep up with inflation. So as inflation goes up, your growth on your property investments are also going to go up and keep up with that. Less risk compared to direct ownership. So that's, you get to share in the equity with other investors. So you're not on the hook for everything. You're not managing the day-to-day operations of it. That's where Richa kind of comes in. She's the GP. She manages all the stuff that, a lot of us don't want to do. She's got boots on the ground, and you get to sit back, earn that income on a consistent basis. And then, yeah, long-term wealth accumulation and potential tax benefits, which Kevin could get a little bit more into on the depreciation side of it.
Thanks, AJ. So I think one of the other points with real estate investing is obviously the tax benefits. And I'm going to go into that. So before we go into that, my background is very similar to AJ's. I used to work for the Big Four for around a decade plus, around 2016. I decided to help the small and medium business entrepreneurs and bring all the sophisticated tax planning and advice to kind of what I call just the everyday people. Prior to that, all my clients were Fortune 500 companies, large private real estate, private equity funds, and things of that nature. And so that's how I got into business, which is very similar to AJ. So what you're getting is you're getting basically what I call the Big Four accountant at a third of the price, as simply put. We're a full service CPA firm. We do everything from personal business taxes, month to month accounting services, and a whole host of other things as well. And what I wanted to get into is the big tax benefits, how to structure real estate correctly. It is the most true and tried and tested way to be tax sophisticated, especially when most of your earnings are coming through ordinary sources, like if you're an engineer, you're a doctor, or a professional, any other professional services. A lot of your earnings are through W-2 or income that you've earned. So you need other ways to kind of offset the offset your taxes and kind of optimize your tax liability. One thing before I go into that, I wanted to just mention, anytime you make a decision, the investment should drive the decision where you put your dollars and not taxes. You don't pay taxes on money you don't make. You only pay taxes on money you make. So at least as much as I'd like to say I'm the most important person here, I'm really not. You have to have your investment advisor kind of walk you through some of this and make sure that your financial long-term goals are taken care of, and you're not just making moves to make your tax liability lower. That's very short-term and myopic thinking. And so going back to how we can relate to the current investment that most of you guys have made, and to that point, we've known each other for a while. We're also investors with Richa, and Ajay and I have worked together for over 2 decades now. So it's not just that we're advisors, we're actually investors in this deal as well. And so the first thing, as most of you know, the main tax benefit of passive real estate investments are depreciation deductions. The IRS allows you to, depreciate a piece of the property every year. And so that depreciation in the early years when it's getting renovated or when you acquire it, that's the big piece that everyone's looking. So you're getting a return on your investment right away through kind of your taxes being lower. And then on the back end, the good thing about real estate is when you sell it, it's not subject to ordinary tax rates, which the highest tax rate is 35%, as opposed to the capital gains rate is 20%. So all your income when you sell it or when a property or an investment is sold is taxed at a preferred 20% rate as opposed to a 35%. So that's a big deal. You're kind of paying the rate arbitrage because when you take depreciation, that's an ordinary deduction that's at 35%, where the capital gains is at 20%. So that's the biggest thing. And again, this thing has been around in the tax code since the tax code's been tax code's been written. So it's one of those true tried methods. Are there any other tax benefits from the property itself? Yes. Real estate is the largest tax lobby. And so they get the most tax benefits. And if they don't go away, they keep adding to it. So even when you sell, instead of paying the 20% capital gains rate, they've put in what's called a 1031 exchange, as most of you may know, where you can trade in a real estate for another piece of real estate in 180 days. Very simplified definition there, but just wanted to at least put it where everybody understands that, hey, if we sell a piece of real estate and we don't want to pay or defer our taxes, there's a mechanism out there called 1031. You don't have to know the ins and outs of 1031s, but it should help you trigger to call at least a CPA to do that if you're down that. And then the other one is that's very relevant to passive real estate investments is if husband and wife, if one of the spouses is working and the other one isn't, and you're actively investing in passive investments, you can leverage what's called a real estate professional for the spouse that's not working. And that lets the passive become active. That's important because if you are a real estate professional and you qualify to be a real estate professional, then the active losses are what we consider good losses. They help you offset any income on your tax return. Where if it's a passive loss, then it only helps you offset passive income on your tax return. And so the real estate professional is something we specialize in, and we help people qualify, tell them what to do, how many hours are required, who can qualify, how they can qualify, is there a way to set it up, and stuff like that. And then that's about kind of the high level stuff on the FAQ side. Wanted to walk through some of the tax benefits, and then just wanted to open it up for questions. If you have a question, please raise your hand and then I can call on you or unmute you, and then we can go from there. I think Ajay and just at least let me know who you're directing the question to so that person can answer between Richa, Ajay, and I. Niranjan, I believe you have a question. Go ahead.
Yes. Can you explain a little bit more active versus passive losses?
Active is any income that you're earning, whether it's through a business or a W-2. Passive is something that is basically where you're a silent investor in, where you don't have a day-to-day responsibility. And so to kind of put that broadly, the IRS, before we get to your income or taxable income, we track your income in 4 separate buckets. Your active income, which is your W-2 or a business that you run that you operate in day to day. We've got interest and dividends, which is portfolio. We've got capital gains, and then we've got passive. And then we keep it all separate. And then there's a complex way to net these 4 if allowed. And that's why the active versus passive designation is key. So for somebody that doesn't have passive income and you have this investment into Nirvana Capital's Austin deal, then that depreciation is going to come to you. You don't lose it, but if you don't have passive income, then you just carry it forward indefinitely till you have passive income. So it's called suspended losses. And that's why we track everything separately.
Thank you.
I think I don't have a lot of hands being raised. So if you have a question, just unmute yourself and fire away, please. Richa, go ahead.
Yeah, thank you. So I have a question, and this is being asked by me. When we talk about the 1031, right? Going back to 1031, you mentioned that to transfer the when you sell one property, then you are able to 1031 into another property that helps in the not the saving but differing of the taxes, right?
Right.
So could you expand a little bit more, because I do get asked a lot of questions on, hey, we are selling this house, can we do a 1031? So can you go a little bit deeper into the mechanism of how 1031 works?
Sure. So first of all, a 1031 is not going to work on a personal residence. So you cannot sell a personal residence and then go into a business acquisition. So let me take that off. But if you have a rental home or any other real estate asset that you are selling, then you can, before closing. So the big thing about 1031 is everybody's aware that it's 180 days before you reinvest your proceeds. But the big thing is it's pre-transaction. You need to have a 1031 intermediary on the closing table prior to, and your share of the proceeds go into an escrow account. And then in 180 days, they will go to any other real estate investment. A partnership investment, buying units in a partnership that owns real estate, is actually not qualified. It used to be qualified prior to 2016. You actually have to acquire real property. So that gets a little bit complicated when you're doing syndicated real estate deals, but it is actually still a viable option if the GP is willing to work with you. So you sell your property, you have a 1031 intermediary, your proceeds from the closing cannot go in your bank account. They go in the escrow's bank account on your behalf. And then when you're ready to buy something, you instruct the escrow account to send the money to the buying table on your behalf from the closing. So the big thing is, where I see a lot of people miss on this, is everyone's aware that it's 180 days, but you technically cannot take possession of the money. It has to go in an escrow, in an intermediary account. And it's a very mechanical rule. If you miss one of the steps, it's either in or out. And then the other thing that I wanted to mention on the 1031 is it's not an all or nothing. So let's say if you have a $10 million sale and you only find property up to 5 million that's worth doing a 1031, then you can just invest the 5 million. So you would pay tax on half and the other half is deferred. So it's not an all or nothing either, which is it's not that difficult, but a lot of people think like, hey, I sold it, but it's a lot that I have to cover, so I'm just not going to do a 1031. Well, you can do a partial 1031. That's perfectly fine.
A bit of a follow-on question to that, Kevin. It's Terry. I was wondering if you can set those up before you know a property is being sold, like the Austin deal. You can set it up beforehand, have everything ready, so then when a sale happens, you're ready to move. Is that how that works?
So Terry, I think what you're referring to is probably what's called a reverse 1031, where you buy before you sell. Generally, a regular 1031 is you sell something, you have the money, and then you reinvest in something. Is that what you're asking?
No, no, not really. I'm just
Okay.
wondering, do you have to know a sale is happening before you can set this up? Or if I have a real estate investment that I know I would want to do a 1031 on, can I do whatever I can do now before I even know it sells?
So generally the trigger point is when you sell something, but that
Okay.
doesn't mean you cannot do what you're telling, what you're asking, meaning that I've got this thing that I want to invest in, like this Austin deal, but I have nothing for sale. But if I have to, I will sell something in some amount of time. Yes, you can do it. That's what's called a reverse 1031, where you have the buying opportunity before you sell. And that is a little more complicated, but you can still do it.
So,
Okay.
Kel, follow-up
Um,
question for you. So for the 1031 exchange, suppose you sell something and you buy something. So whatever you buy, it should be over the price of the what you sold in order to get some tax benefits, or even if it is lower than what you sold, still you can get tax benefits.
To get a full deferral of your 1031, meaning that you don't want to pay, you are not going to pay any taxes currently, you have to buy exactly the same as you sell or more. But you can still do a partial 1031, like I explained, that if you're not able to buy up to the amount that you sold, then we can split it into a taxable sale and half of it as 1031. And I'm just using half for simple math. You can do 20%, 10%, whatever that is that you reinvest. That can be deferred. So it's not an all or nothing deal, okay?
Okay.
I think Richa's got her hand up right now, so go ahead.
Yeah, my follow-up question to Terry's question about was the when you talk about 1031. Now, what about when 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 we exit an investor, let's say in a deal, and they reinvest that money into another deal, so they have a capital gains on one deal, but when they get depreciation on the other, does that depreciation help offset the gain from the one property, the second depreciation?
So it's a very good question. The answer is it does help offset, but you actually don't want it to offset because depreciation deduction is at 35%. Capital gain is 20%. So now you're taking a 35% deduction and offsetting a 20% capital gain. So you've obviously lost 15%. You want depreciation to offset ordinary income, so you get a 35% benefit. So it offsets, it does offset, but it actually, I mean, yeah, it lowers your tax bill in general, but you're leaving 15 cents on a dollar on the table, in my opinion.
But if you don't have any other ordinary income to offset, it's better to offset it up.
Correct. It's better to have something than have nothing. Correct.
Okay, thank you.
And I kind of just want to ask one quick thing on the 1031, just in case other people are curious. If we kind of get indication that Richa is going to exit the Riverside deal in a few years or whatever the timeline is, and people want to 1031, do they need to notify Richa? Do they need to do anything different? Or do they just get the proceeds and then they could go and 1031 into everything?
Correct. So they need to notify Richa because there has to be some pre-transaction planning if somebody wants to do a 1031, and then Richa has to handle that investor by investor. Because remember, if the entity does 1031, that means every investor in this entity is part of the 1031. Nobody's being able to cash out, which the chances of that happening are less than very nil, that everyone wants to roll forward in a deal from deal one to deal two. So it is very seldom that I see a 1031 for the entire entity in a syndicated deal, especially a deal this size, 50 million plus. But if Richa is wanting to work with that limited partner because of their size or relationship or whatever that is, then they need to let Richa know. And then there has to be some pre-transaction planning done prior to the sale for a group or an individual that Richa wants to allow to do 1031. That's up to the GP.
And I think my question was a little bit along those lines. Can I work with her now, even though there is no sale on the table?
Yeah, you'd have to have that conversation with Richa directly, yes. Because, I mean, she's got to give the green light before, I mean, that the thing is, the way it works is we have to kind of segregate the 1031. Let's just say you're allowed to do a 1031 because Richa said, yeah, go ahead. Then we have to segregate you from the partnership and all of the people that, all of everybody else that don't want to do a 1031 and they just want to exit through a taxable sale. Then there's a different treatment for you, and we have to separate you from the remaining investors prior to the sale. And that's a
Oh,
legal
okay.
thing, and Richa has to go. So it's kind of like, it's in our world, it's called a drop and swap. You drop all the investors out of the big partnership that want to do a 1031, and then those people are allowed to swap their share of the proceeds with another 1031. So in our world, we call it drop and swap.
So even for the drop and swap, it is 180 days.
Drop and swaps, yeah. After you are dropped to swap, you have the same rules as any other 1031.
Okay.
And I think a couple of the things I wanted to mention, and maybe that may spur some questions. There's always the question about people pooling their money together to create an LLC to invest to get to the next tier of preferred investments or whatever the goal may be, or get a bunch of family members. That's completely fine. But you got to get that done prior to the close date of the capital raise. And then the question also becomes, can I invest through a self-directed retirement product like an IRA or something? That's perfectly fine. But you got to make sure that the accounts are set up correctly and you have the right broker to set up the self-directed IRA. And that platform allows you to make alternative investments like real estate. So you can have a self-managed IRA through a broker like Fidelity or a clearinghouse like Fidelity, but they're not going to let you make real estate investments or alternative investments because there is basis tracking and stuff that's special, and Fidelity or any over-the-counter brokers aren't going to let you do that. It's usually like independent advisors or their partners that they work with that allow you that autonomy to go invest in real estate outside of a public exchange.
Ajay, I have a quick question for you. When you manage the portfolio, do you charge based on the commission or on the you charge on percentage of the portfolio?
Yeah, so great question. A lot of financial advisors have gotten away from commissions over the past few years just because of the regulations and compliance. So the way that I charge is assets under management, which is an asset-based fee, which on the portfolio would charge on a quarterly basis. So yeah, so if your portfolio goes up, I make more money. If your portfolio goes down, I make less money.
Thank you.
Yep.
So, I have a question, Kevin. You mentioned about an active investor versus a passive investor. Could you give us a little bit more insight what the difference is and how does IRS qualify being an active versus a passive real estate investor?
Simply put, active is something you manage day to day, and passive is something that you do not manage day to day. Technically put, there's a 560-hour requirement. That is how you become an active, and that has to be your main activity. So one of the questions I get is, hey, I've got 20 investments. I spend a lot of time on WhatsApp talking to Richa and sponsors, talking to banks, talking to my financial advisor, but I'm a doctor. So not only do you have to meet the 560-hour requirement, it has to be your primary activity. So if you make your living being a doctor and you still spend 560 hours doing all these things to maintain a portfolio of 20 investments, you're still going to be passive. But in layman's terms, it's something that you actively work on day-to-day managing and earning a living. That's active. If you're not, then it's passive. And the designation is important. The IRS doesn't give you the designation. It's between you and your CPA. You decide which activities that you do, investments and or businesses and or W-2 are active and which are not. And once active and passive are determined, that's when we get to offset losses or depreciation from one investment versus depreciation from other, or income from one and capital gains from other. The designation is important because that's what allows us to net the four buckets of income that any individual could have. And we have, that's where you're allowed to do the netting.
I have a question for Ajay. Ajay, when your chart fees is based on the asset under management. Is there a minimum amount that the investors are required to bring for them to manage, for you to manage, or what's your take on how do you qualify? You say, okay, if you have at least so much, that can be a good start.
Yes. So my minimum for a household is 50,000. That's where I could kind of build a portfolio for you, have the best managers that I've kind of vetted already and do that. But the platform that I use is Fidelity, but on the institutional side. So it's called National Financial Services, just a subsidiary of Fidelity. But for me to go through those platforms and get preferred pricing, it's 50,000 for the household.
50,000 of investment from the household.
Exactly. So it could be 3, 4, 5 accounts, but as long as it's the same household, as long as it totals up to 50.
And those are investable assets, right, AJ? Meaning that money that you can put, yeah, not net worth or something like that. That's money that you can put to work.
Exactly. Exactly.
Would that include an IRA money, or is it going to be just outside of IRA?
Yeah, it could be IRAs, it could be Roth IRAs, it could be a taxable account, any money that would be invested with me into the market.
Okay, and part of your holistic approach, AJ, do you offer any other products besides financial management or like just asset management?
Yeah, so I do life insurance, I do annuities, I do retirement planning, which is a fee-based, a flat fee, and then estate planning as well for my ultra high net worth, where I can hold your hand, talk to an attorney, and basically we would vet out all the questions that the attorney would ask you, so you're not racking up the hourly fees with that attorney. We would sit down, we would discuss who you want your trustees to be, your executors, your beneficiaries, go through that whole process, and then take that information to the attorney for them to draft up the documents for you.
So that leads to the question of, some people ask me if they have a trust, can they invest through a trust? Is that something you recommend? Ultra high net worth not, but I feel like, trust is something everyone should have. And, or like you said, estate planning, right? Is everyone should have that, because, we all are, we all save money and invest. So what's your recommendation on what's the minimum amount that the estate planning that would be beneficial?
Yeah, so I would say there's no minimum. Everybody needs estate planning done, at least a will. Especially if you have little kids, you want to make sure you're designating guardianship for those children, just in case something were to happen to you. Investing through a trust is beneficial because you're also possibly taking assets out of your estate to where it's not taxable, right? In the year 2026, the state the exemptions going to sunset, whereas right now it's about 12 million, I believe, Kevin. So each person can exclude $12 million out of your estate. Husband and wife, they're able to exclude $24 million. But in year 2026, that law is going to sunset and it's going to be reduced by half. So you'll only be able to exclude $12 million total out of your estate. Everything above $12 million will be taxed at a 40% tax rate. So that's huge.
Right. So to AJ's point, one thing I want to clarify, everything we've spoken about is for income tax purposes. And then whatever you accumulate over your lifetime that gets passed down to whoever, your kids and or anybody else, is also subject to transfer taxes or the estate taxes, which have historically been anywhere between 40 to as high as 55%. Historically, the estate tax exemption per individual or per social security has been around 6 million indexed for inflation every year. And so husband and wife can possibly give away close to $12 million. So sometimes you've heard that if your estate is over 10 million, you should really progressively start thinking about trust estates and stuff. And so I think that's still the number. Right now we're at 24 million. It's 12 million per person. So husband and wife can give away 24 million. One thing people don't consider is your life insurance proceeds are not subject to income tax, but they are subject to estate tax. So if you have a $5 million policy, you got to add that to your estate. That doesn't get looked very often because everybody just explains when you're buying insurance policies that it's tax-free, but it's tax-free for income tax, not estate taxes. Number two, and then my reasoning for, so that's when tax benefits kick in, is if your estate is going to be over $10 million. But besides that, I actually am pro on this same recommendation that everybody should have some type of trust, at the minimum, a revocable trust. What that does is anonymity. It may not bring in tax benefits if you're not over 10 million. But one thing I want to mention is if you have a will as your only transfer document, and the will is like a mortgage deed. It gets recorded at the county clerkhouse. Okay, that's the only way it's going to get respected. So you're actually telling the world, this is what I own, these are who my kids are, and this is what they're going to get. Where if you do a revocable trust, you accomplish the exact same thing, but that document is not filed in a public domain. It is actually just filed with you and your attorney, and it's signed and all of that. So I'm a big proponent of having a very limited will, as far as, but not listing all your assets, because there's no need for the world to know what your assets are, who your kids are, and who's going to get what. You don't know what's going to happen in 20 years, 15 years, and especially so I like it from the privacy and the anonymity standpoint, and that's why I think everybody should have it. But from a tax standpoint, it generally kicks in at around 10 million. That's when you need to have it. Like that's when, if you're not thinking about it, you're leaving a bunch of money on the table.
Exactly. And by having a trust, you avoid probate, which is beneficial in a lot of circumstances, because going through the court system, getting a judge appointed to your case, I mean, sometimes it could take 9 months, a year or so. And that means your family is without any money until all that gets sorted out. Right. And if you don't have a will at all and something were to happen to you, then the state's going to dictate what happens. Right. And in the state of Georgia, basically what would happen is if you don't have a will, 50% of your assets will go to your wife or your spouse. I say wife just because usually the husband, in the Indian culture, passes away first just because they're a little bit older, stress and all that good stuff. But the spouse will get 50%, and then the other 50% will get distributed between your children and your wife. So your spouse will only get 50% of your assets, and then the other remaining 50% will get distributed equally.
And you're relinquishing all the control. So as the mother and father that created wealth for whatever generation or whoever you created for, you want to have control. You can use it as a tool. Obviously, I mean, I do quite a bit of estate planning as well in a similar role as Ajay, obviously. And control is a big thing. Trying to drive incentives for your children using what you created can be done in a trust, but cannot be done in a will. So that's another thing: control, anonymity, and then anything above 10 million tax benefits. So it's kind of like a 3-phase. So I think everybody should have it. Personally, I have a medical directive and a will that just says who my kids are. It has nothing listed in my will. I have a revocable trust that lists all my assets. And if something were to happen to me or my wife, who gets what and who's responsible for figuring out that my kids get what they're supposed to get, because you get to appoint the trustees. You have an attorney looking at it. You have a financial advisor looking at it. One of the things that recently happened is one of my family, I think the father handled everything, wealthy family, everything. He passed away. Wife didn't know a lot. And somebody just called to the wife and said, hey, I loaned your husband $100,000. She had no record of it. Nobody put it anywhere. She didn't know anything about the family finances. And apparently it was just fake. And she paid $100,000 before we figured out that this person never gave $100,000 to her husband.
Yeah, I hear that a lot.
So,
Another
you
thing
know,
is-
at the least, what it does, it starts a financial literacy conversation with the family and kind of at least list out all your assets. A lot of people have, it takes, when we go into trust and estate planning, it takes 90 days for a family just to list out what their assets are. And you'll be surprised. It takes about 3 months just to figure out what you own.
So the way I understand is if your asset is total less than 10 million, if you have a will, you're okay. But if it exceeds something like a 6 to 10 million, you should have trust as well as estate planning. Is that what you guys are suggesting?
Suggesting for tax purposes. We are suggesting you should have it no matter what. But a tax is not going to hurt you if you're not over 10 million. If it's over 10 million, then the tax is going to start hurting you as well, because then you're going to pay the 40 to 55% estate tax.
Thank
And if anyone has large life insurance policies, there is a specific trust to put those policies into, and it's called an irrevocable life insurance trust, or an ILIT. And that's where you want to make the owner of those life insurance policies to the trust, and also make the beneficiary the trust. And that will take the, the life insurance policy outside of your estate to where you don't have any control over it, and the IRS deems that outside of your estate.
What I want to say is this line of questioning is just to help you think down the line. You're not going to remember, you're not supposed to remember everything. Trust and estates are like retirement products. There's 1,000 flavors of it, and you can do it 1,000 different ways. So most people need professional help, but at least it gets you to the hardest part is getting to the table to converse about these things with your advisors and your family members. And I think if you take that much out of this line of questioning, I think that's a successful kind of time spent on the last 5 or 10 minutes. Because it doesn't matter how much you read about this, what you read about this, there's 100 different ways to do these things. But I think we're coming up on 4:49 Eastern time. We've got about 10 minutes that was already allocated. So if anybody has questions, we've got about next 5 to 7 minutes. Please use the time. If not, we'll wait about a few minutes before we end this webinar. Again, from a housekeeping standpoint, all our contact information is listed on this slide, which we will circulate, along with the recording of this, as well as a transcription of this shortly after, and through Richa's portal. So that will be available. Richa's got a question here.
Yeah, I do have a question. So going back to the investment, whether you invest, this is like for people who just start investing in real estate, they ask me, should they invest through their personal name or through an LLC? What would you say is the answer?
On a tax answer, it's the exact same, whether you invest. So let me get that out of the way as a tax guy. So the only other reason is why else would you do it? Again, you would do it for legal separation of liability. That's why you create LLCs in the first place. But if you're just making an LP investment, and if it's just your first one, I am very pro to keep things simple and then see how things are progressing. So if it's just your first investment and it's a limited partnership investment where your liabilities are already capped just to your investment, I'm okay making it through just your personal name as well. But eventually, if you start making investment number 2, 3, 4, 5, then I would start accumulating and consolidating all your LP interest into an LLC and having a family LLC or an investment LLC to do so. And that's just for consolidation purposes.
Does that hold true for Ajay? Ajay, if you would, do you recommend investors go through an LLC to invest, to get the financial planning?
Yeah, I mean, in my world, it doesn't really make too much of a difference. It's really just personally liability reasons, keeping everything separate. I have an LLC that I invest through, but my first real estate investment was just through my personal name. I just started doing more investments, so then I created an LLC. But from a financial planning standpoint, it doesn't really make much of a difference.
From a tax standing plan point, it doesn't make a difference. The only reason we see fit to do it is for legal liability and separation of liability. But if you're just making LP investments, LP just means that your risk of loss is just your capital. That's the extent that you're not going to have guarantees on loans, or you're not going to have operational liabilities. then, one way or the other is fine. But I'm always been in the favor of keeping things simple because, you create an LLC, you've got an additional tax filing you got to worry about on March 15th. I'm happy to do it for you, but if it's not needed, I don't think you should do it. But if you start doing investment 3, 4, 5, then now you're kind of like a professional investor that invests in a lot of deals, and you might want to create an LLC at that point.
Thank you.
All right, I'm going to keep it open for about 10 to 15 more seconds. If nobody has any questions, we'll wrap this up. We want to thank everybody for taking time out on a Sunday afternoon to join and at least give us a few minutes of your time. Hopefully we were able to add some information to you today. And if you ever need us, I'm available for questions. And you're more than welcome to reach out at any time. AJ?
Yeah, no, thank you.
Yeah.
I know it's a Sunday, but yeah, Richa, again, thank you for putting this together. If anybody has any questions, there's our contact information.
Yes, no, thank you, everyone. Thank you, Kevin and Ajay. And I will share your information with everyone. This was very helpful, very insightful. And yeah, I've heard about the will and the estate planning, but that's something when I have to get done. So count me in for that.
Please just don't do it on Rocket Lawyer. It's an important document. You want to do it, the right way the first time, and just you got to have, two witnesses as well. So do it right the first time. Spend the money. You don't change it too often. You pretty much review it every 3 to 5 years, but they draw it up in a very generic way.
I mean, at the end of the day, this is your life's worth of earnings and accumulation that you're supposed to transfer over to the next generation. And $39.99 on Rocket Lawyer shouldn't be your only answer.
Right.
But that leads me to, do you guys have a lawyer that you guys work with, or is it like we would find our own lawyer and get the tax and estate planning for you guys?
All of the above for me. I work with partners just like, we've created a partnership across. Sometimes it's driven by the state, sometimes where you want to perfect your documents. Sometimes the family already has an attorney, and then we're open to working with that attorney as well. But for somebody that's brand new to this arena, yes, I work with 3 to 5 different lawyers over the last 5 years across various price points and sophistication that a family can use.
Yeah, same. I would say it's state specific. If you're not in Georgia, I would, if you live in North Carolina, South Carolina, Florida, wherever, I would find an attorney that's in that state because they're just, they know about those state laws. But you want to find an estate planning attorney that specializes in estate planning. You don't want somebody that's doing your real estate closing to draft your estate planning documents.
I think that's a very good point. It's very state driven, but as we see consolidation in trusts and estates to a certain 6 or 7 states, if you find an estate attorney, even if it's not local, he or she may be able to practice and get you domiciled in a state that makes a lot of sense to have your trusts, but your will and your medical directives have to be filed in your own state of domicile.
Okay. Yes, that's what I've heard. Depending on which state, the laws are different. So having the state planning the correct state is very important.
Yeah, I mean, anonymity tax, the ones that come up are Wyoming, Nevada, Delaware, Vegas. I mean, Nevada, not Vegas. But those 3 kind of come to Tennessee's got in the Southeast. Tennessee's got very robust trust and estate laws as well. So that one comes up from time to time for Tennessee residents as well. But those are kind of the 3 or 4 big hitters.
Got it. Okay. Well, that sounds great. Thank you. Thank you so much for your insight, both Kevin and AJ. This was really helpful. So.
All right, everyone, have a wonderful day. Thank you so much again and for your time.
Yeah,
Thank
thank
you.
you everyone for joining. We'll share the details. Okay, thank you. Okay, bye.
Bye-bye.